Good day, everyone. We are here to present our Intermediate Accounting 1 culminating output presented by Group 6 from Section A23, together with my group mates Amparo, Gagarin, Macaraya, Nesrin, and Sacayan. The instructions, we are to analyze and solve the problem given by presenting solution using FIFO method, average cost. If the perpetual method was kept in peso and computed at the time of each withdrawal, the difference of perpetual and periodic inventory, and lastly, necessary consideration on using the inventory cost formula. To start, inventory cost flow formulas are critically important for business for several key reasons, primarily on its impact on companies' financial statements and strategic decisions. It refers to the way businesses assign costs to the goods they sell and the inventory remaining at the end of the period. Since identical inventory items can be purchased at different prices over time, a company needs a systematic method to determine which costs are expensed when a sale occurs. This choice significantly impacts a company's financial statements, particularly net income and the reported value of inventory on the balance sheet. Now we will solve the inventory operations of Slatkin Incorporated for the month of January. From these data presented, we must compute the ending inventory on each of the inventory bases, assuming that perpetual inventory are kept in units only. First is the FIFO method. This method assumes that the first goods received or purchased are the first ones sold. Therefore, the cost of goods sold reflects the cost of the oldest inventory, while the ending inventory is valued at the cost of the most recently purchased items. So from our solution, we use the perpetual inventory method as it has a detailed stock card that shows the transactions per day. But you can actually use the periodic method because both method actually yields the same result for cost of goods sold and ending inventory. The only difference is perpetual prepares stock cards to keep tabs on continuous updates of the inventory until the end of the accounting period. So as you can see, the perpetual method is kind of long and updates every single day that it has a move on its inventory. While if we are going to be using the FIFO periodic method, we can just total the units received, which is 5,700 units, minus the total units issued or sold, which is 4,700, which is equals to 1,000 units as ending inventory. So the 1,000 units ending inventory, we will just multiply that to the latest received purchased unit cost, which is 210 pesos, as you can see from the solution. The total ending inventory of the Slatkin Incorporated is 210,000 pesos for the month of January. Pero ending inventory, if it's in units, is 1,000 units for both periodic and perpetual method for the FIFO cost formula. That's all.
So in letter B, if costs are computed at the time of each withdrawal under the FIFO method, the assumption is that the first units purchased are the first ones sold, regardless of whether a perpetual or periodic system is used. So therefore, if costs are computed at the time of each withdrawal in a perpetual system, the resulting ending inventory of FIFO will be the same as if the periodic FIFO method were applied. This is because FIFO always assumes the oldest costs are expensed first, leaving the most recent costs in ending inventory, and this outcome is not affected by the timing of the cost computation. Under the average cost method, when applied in a perpetual inventory system, where costs are computed at the time of each withdrawal, is specifically known as moving average method. This method continuously recalculates the average cost of inventory after every purchase by blending the cost of new units with the cost of existing units. So the resulting ending inventory value under the perpetual method will typically not be the same as under the periodic method, especially when unit costs fluctuate during the period.
Under the periodic method, we calculate the cost of goods sold and ending inventory only at the end of the period. The weighted average method requires us to determine a single average unit cost based on all purchases made during the month. In total, Slatkin Incorporation purchased 5,700 units with a combined cost of 1,130,400 pesos. Next, we determine the average unit cost. To do that, we divide the total cost by the total number of units purchased. That's 1,130,400 pesos divided by the 5,700 units, which equals 198.32 per unit. Now we move to total units sold. Across several dates in January, Slatkin issued a total of 4,700 units. To calculate the cost of goods sold, we multiply the number of units sold, 4,700 units, by the average cost of 198.32 pesos. That gives us a total cost of goods sold of 932,104 pesos. For ending inventory, we take the remaining 1,000 units since 5,700 were bought and 4,700 were sold, and multiply that by the same average cost of 198.32 pesos. This results in an ending inventory of 198,320 pesos. To summarize, the average cost per unit is 198.32 pesos. Cost of goods sold, 932,104 pesos. Ending inventory, 198,320 pesos. The weighted average method provides a consistent, simplified approach to inventory valuation, especially useful when prices fluctuate. It avoids the complexity of tracking individual purchases layers like FIFO or LIFO.
The perpetual and periodic inventory systems are two different ways that a company keeps up with their inventory. The perpetual inventory system, for one, makes constant updates of inventory records after every sale or purchase transaction. This means that the company always has real time, up to date data on how much inventory levels it has. Every time a product is sold, inventory balance is automatically reduced and cost of goods sold is immediately recorded. When recording transactions, this system debits the inventory account for purchases and credits it when sales happen. The perpetual inventory system is usually used by businesses that rely on accurate inventory tracking, such as large retailers or those with expensive products. On the other hand, the periodic inventory system only updates inventory records at the end of the period. Instead of tracking every sale as it happens, the company waits until the end of the period to count the inventory physically and calculate the cost of goods sold using a formula. So the formula used is cost of goods sold is equal to beginning inventory plus purchases less ending inventory. Instead of using the inventory account title, it uses purchases and sales when making those separate transactions. This system may be much simpler to use and cheaper to manage. However, it doesn't update the inventory levels as frequently, thus lacking timely data on the amount of inventory. In short, the perpetual system gives continuous updates and more accuracy, however, requires more technology and cost, while the periodic system is easier and cheaper but only gives information after the fact. Choosing between the two depends on the size of the business, the type of product sold, and how important accurate real time inventory data is.
We should consider understanding the importance of selecting a suitable cost flow formula for inventory valuation, as it directly impacts a company's financial reporting and obligations. So, when determining the most appropriate formula, we consider several key factors. First, we examine the nature of the inventory itself. For instance, if the inventory consists of identical or similar items such as raw materials or commodities, a formula like first in first out or the FIFO and weighted average cost must be suitable. On the other hand, if the inventory comprises unique or distinguishable items such as artwork or custom-made products, a specific identification might be more appropriate. We also analyze the pattern of cost fluctuations and their potential impact on financial reporting. In periods of rising prices, FIFO might result in lower cost of goods sold and higher profits, whereas in LIFO might lead to a higher cost of goods sold and lower profits. Conversely, during periods of falling prices, FIFO might result in higher cost of goods sold and lower profits. The weighted average cost method can help smooth out fluctuations and provide a more suitable valuations, but it might not accurately reflect the actual cost of specific items sold. Industry practices and norms are another crucial consideration. We often look to industry peers or widely accepted practices within the sector to inform our decision. For example, companies in the retail industry might prefer FIFO while those in the manufacturing sector might opt for weighted average cost. Additionally, we accountants consider the tax implications of each cost flow formula, as some methods may result in higher or lower taxable income. Ultimately, our goal is to select a cost flow formula that provides a reasonable and accurate representations of the company's inventory costs and financial performance, and we strive to ensure that the chosen formula is consistent in the company's financial reporting requirements and objectives, that it is applied consistently to ensure comparability and reliability of financial statements. If a change in the cost flow formula is deemed necessary, we ensure that the change and its impact on the financial statements are properly disclosed. By carefully considering these factors, We can provide stakeholders with reliable financial information and help the company make informed decisions about its inventory management and financial reporting.